Welcome to the Explainer. If you're staring at your portfolio right now, the sheer amount of financial jargon out there can feel absolutely overwhelming. So today, we're cutting straight through all that noise surrounding stocks and bonds. Our big goal in this Explainer is to put you directly behind the wheel of your financial future by breaking down the simple, structured basics you actually need to build real wealth.
And that brings us to the ultimate core dilemma, right? You've managed to save some of your hard-earned money, and now you need a place to park it. Stocks or bonds? Which one should you actually choose, and what's the real difference between them anyway? Answering this is the foundation of literally every successful financial journey.
So, here is our roadmap for today. We're going to quickly cover the beginner's dilemma, stocks as the growth accelerator, and bonds as the stability brakes. Then, we'll look at stocks versus bonds compared, building a balanced portfolio, and finally, taking your first steps.
Let's dive right into part 1, the beginner's dilemma.
Moving on to part 2, stocks, the growth accelerator.
I want you to think of your financial journey kind of like driving a car. In this scenario, stocks are your vehicle's powerful engine. They're the accelerator. But what is a stock, practically speaking? It's not just some blinking ticker symbol on a screen. Stocks are literal pieces of ownership. When you buy stock in Apple or Tesla, you actually own a tiny fraction of those companies, their innovations, their factories, and their future.
Okay, so how does owning that tiny piece actually put cash into your pocket? Well, it happens in 2 specific ways. First up, capital gains. This is pretty simple. It just means the company becomes more valuable over time, the stock price goes up, and you eventually sell your piece for a profit. The second way is through dividends. This is when a company actually decides to take a portion of its profits and pay it directly to you, in cash, literally just for being a part owner.
Now, historically speaking, the average annual return for stocks sits somewhere between 7 to 10%. When we talk about hitting the accelerator pedal, this is exactly what we mean. Over the long haul, stocks show massive growth potential, aggressively compounding your money year after year.
But, driving fast definitely comes with some realities you've got to prepare for. Let's look at the pros and cons. The pros are huge. High long-term growth and the amazing ability to own a real stake in the world's greatest companies. But the cons? Well, mashing the accelerator can make for a pretty bumpy ride. Stock prices can and do drop sharply in the short term. They carry a higher risk, which means your portfolio's value is definitely going to bounce up and down along the way.
All right, part 3, bonds, the stability brakes. Since we obviously don't want to speed completely out of control, we need some brakes. If stocks are all about moving fast, bonds are your vital control mechanism. Here's the difference. Unlike a stock where you are an owner, with a bond, you're actually a lender. You are giving a loan to a company or maybe a government entity, and in exchange, they promise to pay back your original money. That's your principal, plus regular interest over time. Looking at the historical returns for bonds, we see a totally different picture than we did with stocks. Bonds typically offer a 3 to 5% average return. Yeah, it's a significantly lower number. But remember, this is the slower, vastly safer financial route. It's all about preserving your momentum, not setting speed records. Let's break down these pros and cons too. The massive pro of bonds is that they're much more stable and predictable. You get those regular interest payments, and they carry way lower risk, especially if you're lending to the government through U.S. Treasury bonds. The cons, though, are those lower long-term returns we just talked about. Also, it's super important to know that if broader interest rates rise in the economy, the prices of your existing bonds can actually fall.
Part 4, stocks versus bonds compared.
Let's bring both of these concepts together to see how they operate dynamically inside the same vehicle. On one side, you have stocks, your accelerator for growth, pushing you toward much higher long-term wealth, but definitely with a bumpier ride. On the flip side, you have your bonds, the brakes for stability, smoothing out your overall journey with steady, predictable returns.
Which brings us to part 5, building a balanced portfolio.
Listen, a safe, fast car literally needs both an accelerator and brakes to reach its destination without crashing. If you only own stocks, a severe market crash could completely wreck your plans. On the other hand, if you only own bonds, inflation is going to outpace your growth. For beginners, the smartest approach by far is a blend. A very common starting point usually sits around 70 to 80% in stocks for that essential growth and 20 to 30% in bonds for stability. For instance, a clean 75-25 split is incredibly popular.
So how on earth do you know when to adjust this ratio? Honestly, just remember this golden rule of thumb.
If you won't need the invested money for 10 or more years, you should lean much heavier on stocks. You have the time to ride out all those short-term bumps. But as you get older or closer to actually needing that cash, you should lean heavier on bonds for safety. You start pressing the brakes to secure the wealth you've already built.
And finally, part 6, taking your first steps. All right, now that you fully understand the mechanics, let's put the keys in the ignition. I want to issue a really simple, empowering challenge for you this week. Decide what your personal risk comfort level is right now based on your timeline. Then, just look into 2 things. One low-cost index fund to represent your stocks, and one bond fund to represent your stability. You don't have to go out and buy the whole market individually. These funds package the whole shebang up perfectly for beginners.
$50. Seriously, you absolutely do not need to be rich to begin investing. Even starting small with just $50 to $100 is a magnificent first step. The real secret to this entire process isn't having massive amounts of upfront cash, it's about starting small and staying incredibly consistent over time. That is exactly how real wealth is built.
As we wrap up this explainer today, I want to leave you with a quick thought to reflect on as you plan your very next move. Look closely at your own life, your specific goals, and your unique timeline. Are you building for aggressive growth right now, or are you prioritizing safety? Figure out exactly where you are on your journey, adjust your pedals accordingly, and start driving. Thanks so much for joining me on The Explainer, and keep learning.